Do you see a material maturity wall that suddenly makes the rates that we're seeing in the market something that companies have to actually grapple with in terms of higher financing costs?
Yeah, I mean, it's a great question. I think on the investment grade side, what we're seeing is actually a fairly manageable maturity wall where those towers become a bit more of a concern, I think, is in the loans market and the high yield market more specifically. But, I think it's fair to say no one is in holiday mode yet on the investment grade side of the markets, with the report on Friday really opening the door to one more bout of issuance to close out the year. We're in the middle of some go-no-go calls as we speak. But what we're seeing is a number of CFOs and treasurers that are just looking to find opportunistic windows and to take advantage of positive technicals when they arise. In this case, they're trying to get in ahead of CPI, ahead of the Fed, and maybe more importantly, a growing January backlog. But it's largely going to be bank and finance centric. The corporates, I think, are looking at fundamentals that are in very good shape and willing to wait things out, and have given some credibility to the idea of multiple cuts being priced in, and are going to wait for those to come and go before they elect to move forward.
This sort of sets up an interesting dynamic. People have been talking about the great shrinking of public debt markets, and essentially that's what you're seeing in corporations at the same time that the government debt market is ballooning in terms of size. How much do you see this continuing? That essentially the overall size of high yield and investment grade bond markets continue to contract, a positive for the fundamentals in terms of investing in it, simply because companies don't need to raise more money, and if they can raise money elsewhere, they will.
Yeah, I mean, our call at Barclays is that we're actually going to see reasonably stable investment grade issuance as we look to next year. So it's 3 years in a row of $1.25 trillion of debt issuance. That'll be the third straight year. I think the notable change is likely to be more around the composition of that supply. So if you look at ratings, sector, and tenor, I think we're likely to see a much larger percentage of single A and higher borrowers. We're likely to see an increase in terms of financials, in terms of that mix, with spreads near all-time tights, and you're likely to see long-dated supply continue to underwhelm. So I think there'll be a bias to stay short until we get towards the end of this cycle, which may take some time to play out.
And Meghan, Gina Martin Adams of Bloomberg Equities, Bloomberg Intelligence, was a spirited conversation on Friday. They were all looking at the parlor game that you're glued to 24/7, and we're forgetting about the real economy, which you and Lisa just talked about, with debt issuance as well. Are we overemphasizing the Fed game of Wednesday? Are we all addicted to the dots and the polling in the futures where we should be less so?
Yeah, I mean, I've not been overly surprised to see a bit of a Santa rally emerge as we round out this year, in large part because we're entering next year, I think, with a growing sense of optimism. And that's not because we don't expect the economy to slow. I think we definitively do. It's not because we think inflation makes its way to 2% target anytime soon. In fact, our baseline is that we end the year closer to the high twos. I think the risks to the downside are shrinking, but it does then beg the question, as you suggest, are the 4 to 5 cuts baked in actually a response to an economy where the data is actually necessitating an aggressive Fed move? Or is it a reflection of a market that's bullish and re-risking? And I think there's a real case that it's the latter.
So take your legit pro conversation and run it out to Cupertino, California, or 7 other places where they're all under bond. They desperately need to do a deal with Barclays. And the answer is, why aren't the techs issuing bonds right now?
I just think all-in yields feel excessively punitive. I mean, even with a point move lower off the peak, I think there's real buy-in to the idea that rates could move lower over the course of the year. And with maturity towers manageable, the ability to wait that out is more palatable. You can hide out in CP, you can hide out in the very front end of the market without locking in these levels for a pronounced period of time. So.
Sorry, we've been talking about investment grade, and I just want to get this in. I do want to touch on high yield at a time where spreads, the benchmark yield over the yield, extra yield over benchmark rates, has dropped to the lowest going back to April of 2022, the lowest in 18 months. Can this keep going lower?
I think it can. I don't think it will be a one-directional move. You're seeing signs of life. I think there's a real willingness to stay in the upper echelon of the high-yield market at the moment. If you think that we're headed for a soft landing, risk appetites do seem to be coming back into the fold. And so the amount of cash flooding into the credit markets at this point in time to take advantage of renewed carry opportunities is very much there. But I think it'll be a credit selection play next year for high yield, and dispersion will be the name of the game.